get interference analysis. We didn't look at 37, did we? Which is more of a reading problem, but that seems to be where we have some problems. Here we got a two-part transfer of pricing. Two-part meaning we're going to have fixed and variable. On page 578, let's look at that again. It's not one that's hard mathematically, it's just reading what they tell you. Not much math to it at all. You got CHS is a large multi-divisional firm. One division, health services, well known inside CHS for its efficient information technology. No such thing. A smaller division, optics, has approached health services with a proposal that it provide IT support in the form of machine time for some of optics billing administrative work. After an analysis of the demands that Optic would place on the system, IT manager of health services notes that health services would have to lease a new server because of additional load. The lease rates for the current server is a fixed annual lease of $3,200, and it averages machine time of 2,800 hours annually. The new server leased for an annual rate of $5,000 because the because the new server is a faster machine. Health services could complete its current requirements in only 2,000 hours. The work for optics is estimated to be 1,000 hours. Now, in addition to leasing a new server, there are two other changes health services would have to make in IT. First, they would have to upgrade their server support position. The IT manager estimates it will cost an additional $20,000 a year for an individual with the necessary advanced training. I sure hope that's above the current salary, not just $20,000 for that position. In addition, health services has a contract for a service from the machine vendor. The support contract is a fixed price of $1 per hour of machine usage. The current lease agreement can be canceled at no cost if health services leases a more expensive machine. Now it says assume that no outside market exists for this service and that health services would have excess capacity on the new server. What's the optimal transfer price rule health services should use to charge optics? So what the heck are they telling us here? There's one item that, right back, there's one item that complicates the issue, and there's one that simplifies it. The complication is that the need for a new server is only because of the optics demand, right? If we don't follow optics, we don't have to add a new server. Now, it's simplified in a sense because they simply lease the machine. So, since there's no intermediate market on it, what would be the optimal transfer pricing rule? Anybody remember? Reading it? Well, it would be the incremental cost. What do we mean by that? Since there's excess capacity with the new machine, it would be, the incremental cost would be the one. What incremental cost do we have?
$1,800 more for the lease on the server.
Okay. That's a fixed cost, right?
Yeah.
So we really have a fixed cost here. Lease. 1,800. How'd you get that 1,800 again?
Because the one that they're paying for now is $3,200, and
Okay.
for the new one it's $5,000.
Yeah, simply 5,000 minus the 3,200. Have an increased charge of 1,800 there. What else? What else?
$20,000 they gotta get for the individual.
Okay, the administrative assistant, the salary, they estimate that at 20,000. Okay. So that's what, subtotal there, 21,800. Anything else?
The variable cost of the $1 per hour. for support.
Okay, variable cost is $1 an hour. That's pretty good. You got all of it except one item. What are we leaving out? Just that short 2 paragraphs there.
Would be the change in machine hours.
Okay. What's that change in machine hours do? What's happening there?
They had to get the new server because their old server couldn't handle it. So since they got the new server that runs faster, it freed up more space on the new ones they could take.
Well, yeah, not space, but we're looking at costs. What's it free up? You're on the right path.
Takes off the cost that they had to run it at 28 instead of running it at 2,000.
They're gonna save $800 on their maintenance. It's $800 less, $1 an hour. So, the health serving there, they're gonna save $800 on their own work. So basically, what it would be 21,000 fixed cost plus $1 per hour. That would be the transfer price. Now, it says there, suppose Optics uses 1,000 hours on the new machine. What's the average cost per hour? Optics should pay using the rule you developed in the first part there. What are we going to charge them?
$22,000.
And how much would be our unit hourly cost?
$22
Yeah, that's all they're asking. If they do 1,000 hours, we got a fixed cost of 21,000. Remember, you know, your fixed variable 1,000 hours times $1 an hour is 1,000. 22,000 divided by 1,000 hours. 22 per hour. That's all they're asking. But what if it says there in C, says suppose it's 100 hours on the new machine?
$2.11 an hour.
That's right. It's still going to be 22,000 when we charge. But now when you take 22,000 divided by 100 hours, 220, did you say?
I said 2.11.
Ah,
I said 2.11.
then what is? Okay. Now look, again, very simple, same. Notice there though, notice 38 there, just change this a little bit. Now, Health Services has the machine, they can sell time machine to other companies in the area on a per hour basis. He can sell all the time available for $30 an hour and sell it to others. So now what should be what's the optimal transfer price Rural Health Services should charge to Optics? Does that change anything? What are we going to do? What's the price we're going to charge them? What's going to give us the correct signal for Optics and for Health Services? Snake and doesn't bit you. It's the market price, guys. $30. $30. The market price. It's going to give you the signal both to Health Services because that's what they're charging. That covers their costs from what they're calculating now, since that's what they're charging to outsiders. So Health Services that provide more, and Optics, that's the going market price. They want to use more or less, whatever. And then again, it says they go back. Well, what if they use 1,000 hours on the machine? What's the average cost that Optics would pay using the rule that we developed in Part A?
$30.
$30. And if they use 100 hours, what would be the price? $30. The market price. So if you have an intermediate market and all that, the signal they'd send you is what they would use. Again, when you do have an intermediate market, it makes things a whole lot easier. Because when you see what the open market, what it's calling for, and what the demand is, what satisfies the demand. Okay? They do that all the time. They have a thing called gasoline pump. When they have changeovers, part of the reason they said the price of gas went up is they had a lot of refineries offline. So you have a limited amount of gas, so what do? You have the price. Sends a signal to the market, use less. I mean, granted, there's many more factors than just that, but that is a major one. Price goes back down, and signal is, we got plain gas, we use more. Okay. Now, any questions on this chapter? Anything you want to go before we go into variances? No? By the way, I'll make a decision on Friday. I think we're probably going to move the test date up, class period. Because I don't think there's any way I'm going to be able to say anything about variances that many sessions. I think when they got screwed up when evaluating the calendar, we always generally switched Monday and Fridays coming out of spring break. This year we didn't, and I don't think I realized that. We've got some things screwed around. So I'm going to evaluate and might change some dates on homework, but you'll have plenty of notification. That won't. Used to be we always came out of spring break. We would come out and this should be a Tuesday, Thursday, Friday instead of Monday, Wednesday, Friday. Because we had a Monday, Wednesday, Friday going into spring break. We had a Monday, Wednesday, Friday coming out of spring break. We used to just drop spring break out and just keep the rotation going, which is 6 of one, half dozen of the other. But the reason I was told why we don't do that anymore is because the computer program we have, they don't know how to deal with it. So we got that computer. They finally got a computer program and got it programmed to rotate those Fridays on it. It took them forever how to do it in the schedule book. I don't know if they ever got that right. You'll notice it's still a little bit odd. I think it's a Monday, Wednesday, and then I'll have it drop down, and a Friday down there instead of Friday one. They've always had a terrible time with that, trying to, because we're one of the few universities still has that floating Friday. Most places are Monday, Wednesday, Friday, or Tuesday, Thursday. A lot of 15-minute classes on Monday, Wednesday, and an hour and a quarter on Tuesday, Thursday. And so, who knows? But I always like, again, there's an example of the tail wagging the dog. We don't know how to fix the computer program, so we'll just change everything to fit the computer program. And does that happen all the time? We're not unique, unfortunately. Now, let us go to the next chapter. And variance analysis. And what do we mean when we say the word variance? What's that mean? That's not a new word, is it? What do we mean by variance analysis? Or variance, I mean, just the word variance.
Like the difference between two
Different.
numbers.
Yeah, difference. That's all it means, difference. But it doesn't sound real professional to say, well, these are the differences. So we say, here are the variances. Make it sound really nice and smart and educated. But all they're doing is saying we're going to measure things and compare the differences in the two. Now, one thing you got to get set, and we'll go through this a little bit here, explaining how we get a lot of these. A lot of this, variances do not give us answers. They give you questions. But it gives you a way to start asking questions. Because basically the answer is, we got a variance here. The question is, why? Why is there a difference? What's going on here? Hey!
Sorry.
Oh, it's okay. Why is there a difference? Now, and you'll hear me say this over and over again. One of the first questions you always want to ask yourself on variances, and this is whether it's either good, bad, whatever, is, do I have a 36-inch yardstick? Everybody goes, huh? What do you mean 36-inch yardstick? Well, how many inches are in a yard? 36. If I want to know how many yards this room is, and I say let's measure it, if we got a 34-inch yardstick and somebody else got a 37-inch yardstick, we're going to get different answers, aren't we? And what I'm saying here is, when we start comparing the differences from whatever we're using to measure, and basically we're going to look at budgets as our measuring stick, difference from budget. One of the first things you've got to look at are standards there. Are they realistic? And if they're not, then that's going to tell us a big reason why we got a difference. You know, and you say, what do you mean? Well, a couple of years ago, when gas shot way up, I guarantee you, every school system in the state of Kentucky or in the United States came up with what we call an unfavorable variance for transportation costs. Meaning they spent a whole lot more than what was budgeted. Why? Well, their budget was unrealistic. It budgeted $1.50 a gallon. It's selling for $3-something a gallon. Don't take them rocket science to figure out. You ain't gonna hit that number. Now, I keep talking good, bad. Generally, when we talk about variances, we're gonna talk unfavorable or favorable. And yes, on exams, when you take the test for this one, if you don't label it as either a U, F, or unfavorable, favorable, I'm probably gonna take a point off when you calculate variances. Now, you say, well, how do you know if it's favorable or unfavorable? Real simple. If it increases profit, that's favorable. If it decreases profit, that's unfavorable. I mean, think about it. Now, remember, when we're talking about revenue variances, and expense cost variances, rules change, right? On revenue variance, we would like to be over our budget. You say, what do you mean? Would you like to have a job that pays $30,000 a year, or would you like to have one that pays $70,000 a year? We'd rather have the ones more, right? So if we got a job that's budgeted for $30,000 and we make 70, that's definitely favorable to us as the individual. On the other hand, let's say that you're going to go to the movie. Let's say some young gentleman has asked you out, Caitlin, and going to take you to well, we got the big cinema here in Moorhead now, right? We got what, 5, 6 of them now? The multiplex, or whatever they call it over there. Never been over there. So I do want to get out. I want to go see that Oz movie. I hear it's pretty good. Anyway, that gentleman budgets, well, I'll spend, $15 for movie tickets. Well, you go to the movie and it's $10 a piece. And being a gentleman, he buys your ticket. Well, he spent $20. Well, that ain't good to him. That's unfavorable, right? Especially when, she'll probably want popcorn cup too. It's real unfair. But the thing about it is, that's what I mean. You spent more than what you thought you would. That's unfavorable. So whether it's favorable or unfavorable, really not that hard. Just use common sense. Put it in a personal example like that. Well, is it, I budgeted, $500 for this. Well, I had to pay $700. You probably won't like do well. If you budgeted $500 and you only had to pay $400, smell like a rose, right? You like that. That's favorable. And so that's what we want to look at in coming to these. Now, you got to have a yardstick. Like I said, you got to have something to measure against. And one of the things that we use, remember a couple of chapters back, we did all these budgets. And that's what we're going to use as our yardstick. Now, one of the problems is, we got a problem with using that. We use budget. Remember when we talked about budgets, we said, okay, we use them for planning, for communications and planning, all that good stuff. Well, we also said we use it for evaluation. Well, this is one of the ways we use budgets for evaluation. We're going to start looking at actual results compared to budgeted results. Well, that may be different to mine. Now, we're going to look at it for evaluative purposes. Now, be careful when we do label budgets like favorable or unfavorable. That is not synonymous with good and bad, though it tends to be, but don't be careful. I've got an example here to show you how that illustrates it better, but they're not necessarily good, bad, whatever. It's just favorable or unfavorable. And but again, our operating budgets. Remember, we have budget income statements, production budgets, cost of goods sold budgets, supporting budget, direct materials, labor, overhead budgets. All those good things y'all love doing and coming up with. Right, Alexis? So they do a lot of that. And of course, financial budgets, again, cash budget, balance sheet, and all that. Again, we can use any of those budgets. We're looking at measuring against. Obviously, operating's going to be on a lot of it. And a variance is the difference between a planned result and actual outcome. Now, again, like I say, when I say, do we have a 36-inch yardstick? What I'm saying is my budget realistic? If my budget's not realistic, the variances I get, whether they're favorable or unfavorable, really doesn't tell me anything. If my budget was unrealistic, my variance analysis is not going to be any help at all. And by the way, you may find out that a favorable variance in one area leads to an unfavorable results in another area. and we'll discuss it as we go on, but, you know, you could have, a lot of these variances are going to be interrelated. And so you gotta, again, be aware of that. And what's causing it. And I'll be honest with you, a couple of the fixed variances really don't tell you anything. A lot of people still calculate them, but really it's not, I can tell you before you start, basically where it's going to be favorable and unfavorable. Now, profit variance, obviously, you know, anything that increases profit, that's favorable. Anything decreases, it's it's unfavorable. Like I said, if it increases the bottom line, our profit, we like it. If it decreases it, we generally don't like it. And that's not a hard thing to remember. It's pretty much common sense. It's just remember the rules for favorable and unfavorable are going to be opposite for a revenue or an expense, because revenues and expenses are opposite. Debits and credits even, right? Now, you know, here we got the master budget. Now, the master budget, remember, is a one point in time. 1 point in time. And so, notice we budgeted $100,000 at $10 a unit. That's where we get the million. Our variable cost, we said, was $3.80. Variable manufacturing, variable selling was 90 cents. So 100,000 units times this, that's where we get that. And then our fixed overhead and fixed selling administrative, and hence profit down at the bottom there. Get that out of the way. But notice here, variances, you know, is just the difference in the two. Notice we sold 80,000 units. That's not as good as selling 100,000. 100,000, we would have more profit, right? Sales price, notice it's 160 unfavorable. Again, because it's less. Actual is less than budgeted. Now notice on expenses though, the expenses are less than what was budgeted, but notice we got little F's there. That's favorable. We spent less than what we thought we would. So is that great and glorious? Why is that not a big deal? Why we better take that with a grain of salt?
You spent less because you didn't sell as much.
Exactly. You know, I would assume my expenses, my variable manufacturing and variable selling, all that would be less, because selling 80,000 units and as opposed to 100,000 units, yeah, it should be less, right? So if we're doing these overall variances like this, that's why I say it's not necessarily just because it's favorable do you say, yippee-ki-yay, we did a great job. You got to be careful. We would just expect it to be. Those contributions unfavorable. Overheads, you know, they were favorable, but profit was unfavorable. Now, in actuality, that really don't tell me diddly squat pretty much. I mean, it shouldn't take a rocket science to figure out, yeah, revenue is going to be unfavorable, profit's going to be unfavorable, my expense variances are probably going to be favorable because of the difference in volume right off the bat. Now, the thing of it is, you know, we prepared this master budget. Remember, when we were doing this, you know, if this is for the year 2013, we probably put this together in the fall of 2012, right? Now, the problem we have is we don't always operate the same level. So what do we do? What can we do? Well, there is a way to hedge your bet. And one way to hedge your bet is to do a flexible budget. Now, what some companies will do, they'll make a series of budgets instead of just, you know, and then you say, what do you mean? Well, we might say, okay, I'm going to make 5 different levels. I want to do 70, 80, 90, 100, 110,000 units. And then I'm going to multiply it by my sales price. I'm going to multiply by my variable cost per unit in each of the categories. Now, my fixed cost here would remain the same in each level, right? My budgeted fixed. But then but I can see what would be my budgeted profit at each level. Now, at that point, when I use flexible budgeting like that, then I can go in and select the level closest to actual. And I've got a more realistic yardstick to compare actual to budget. And somebody says, well, what do you do with those other columns? Throw them in the trash can. Zap them off the computer. You don't need them. Yeah. So, in other words, then I can start comparing. Static budget, one level. Again, flexible budgeting, we're going to make it at all different levels. Let's see. You would know. Okay. I love when my mind goes blank. I'm like, where did I see that at? I probably saw it in another book that I've been reviewing. Okay, sales activity. Difference between operating profit, not master budget, operating profit, and the flexible budget that arises because different units sold. Now, in this case, if we do a flexible budget for $80,000 and compare it with that master budget of $100,000, we're going to come up with our sales activity of variance of 20,000 units, right? And so, now notice what we've done here. We said our sales was $10 a unit, so if we sold 80,000, then our flexible budget we should have sales of 800,000. Variable manufacturing costs at $3.80 and 90 cents for selling administrative. We get those numbers. Notice again, your fixed cost should be zero variances. I mean, by definition, fixed cost does not change with level of activity. So in budgeting and all that. So now we have overall profit $106,000, but we got a little bit more accurate yardstick of what to measure actual results with. Now, when we start breaking it down, we got sales price variance, we got our fixed production cost variances, variable production cost variances, and obviously marketing administrative cost variances. Now, with let's just show you. In coming up with this, notice you got all these columns, like, ooh, how in the world? Basically, you're probably, you're not going to present that somewhere. This is just showing you how it's all filtered together. We're going to break this down a little bit. And notice here, going through it, the sales activity we've already noticed. That's just the difference in these two. Different levels of volume accounts for that. But now notice here, the flexible budget, our sales price variance. We actually had sales of 840. But according to our budget, we should have only had sales of 800,000. We got a 40,000 favorable variance. In other words, just out of curiosity, what's 840,000 divided by 80? It's obviously more than $10.
10 and a
$10.50. So we actually sold it on average, and again, does that mean we sold everything for that? No, but on average, we sold it for $10.50 a piece, right? So notice we had a 50-cent, our sales price was more than what we budgeted. That's going to be favorable. We were able to sell it for more than what we thought we would. And again, that explains part of the variance there. We were able to sell it for more than what we had hoped. Now, our manufacturing cost, and again, we're going to break that down. What's variable manufacturing going to consist of, by the way? What would be the ingredients in variable manufacturing?
Direct materials, direct labor and overhead.
Direct materials, direct labor, variable overhead. That's going to be your variable manufacturing cost. Notice that under fixed cost, you got your fixed overhead there. Remember, everything we've made, I know you're tired of me saying it, materials, labor, overhead. So we're going to break that variable manufacturing cost. Overall, we got an unfavorable manufacturing variance there of $25,680. And we need to know what cost. I mean, it could be that, hey, we bought more materials, we used more materials. So that's why I say, we come up with this $25,680. Again, unfavorable. We spent more than we said we should have spent $304. We actually spent $329,680, and we got an unfavorable variance, but it doesn't tell us why. That's why I say you generally have to ask several levels of why. Why did this happen? And you say, well, what's the good here then if it's not giving you answers? Well, it's helping you frame the questions. And we start looking, well, why did we spend more? Well, I mean, let's just take materials. Why would we have spent if materials is part of it? Now, by the way, it may be that some are favorable and some are unfavorable. It's usually not everything's unfavorable to get total that. It's usually a give and take. But I mean, it could be that we had a hike in our vendors. Our vendors hiked. We had like I said, that budget with schools a couple of years ago when we had that real spike in fuel prices. Materials went up. It could be that we had faulty equipment. How would that make you, how would that increase our manufacturing costs? Well, go back to you making cake. You left it in the oven too long, burned it. Guess what? You got to throw it out. Well, that happens a lot in manufacturing, right? We leave it on, leave it running. The equipment doesn't drill it precise, doesn't cut it precise. We have to scrap it. Anytime we're scrapping it, it's costing us more, right? Or it could be that our workers weren't paying attention and we used more materials. They were inexperienced, younger workforce in this period, and they went through more materials than they should have, according to budget. It could be labor, like I said. It could be, why would we spend more labor? Well, we had our workforce. We used an older mix, which tends to be higher wages. People have been there longer, right? So our average wage rate went up. Or it could be that we had to work some overtime. Or, that usually goes to overhead, though. Overtime does. We calculate these things. It could be that we had a contract increase, right? Labor contract increase. Could be a reason. Overhead, utility rates went up. Tax rate, property taxes went up. It could be all kinds of things. Now again, but what we try to do is we start breaking it down, isolating, like, okay, why? What happened? Most of the time, when you get these pristine reports, the annual report and all that stuff, yeah, they're nice, and yeah, you have to do it, but what's it telling you? So by doing some analysis here, we're trying to find out, well, what really went on. Sometimes I think they'd probably pull their hair out when they find out what really went on. But anyway, Notice we do have some overhead variances. And you say, well, how'd that happen? Well, a lot of times with overhead and all that, depends on how it's applied. I can tell you with variable overhead, if you use direct labor to apply it, and most of the time in these examples, that's what we will be doing. If you've got a favorable variance for labor, you're probably going to have a favorable variance on variable overhead, just because that's how it's applied. If you got unfavorable, the unfavorable one, unfavorable the other. Fixed overhead, if we operate at different volumes, you got a volume variance. And we wouldn't here with the flexible budget because we're operating at the same level, 80,000, 80,000. But again, all we're going to do is break down this and try to find out, okay. And again, you say, do you investigate the variances? Yes. And most of the time we look at it and say, yeah, unfavorable variances, we want to really find out what's going on, try to see if it's something we correct. But you also you investigate favorable variances. You say, why? Is it something we could duplicate? Now, again, what you got to be careful of is changing your standards all the time. And you say, what do you mean? Well, typically, in budgeting and all that, you got to be careful. Again, using these as standards, because if we keep getting favorable variances all the time, what's the first thing we tend to do? We do it. Most humans do it. Management definitely does it. If we keep getting favorable variances all the time, what's going to be what's a gut reaction?
Shut the bar to what?
Standards are too easy. Standards are too easy. So what do we need to do? We need to toughen the standards up, raise it up, right? And if you keep increasing your standards and all that, sooner or later you're going to get to an unfavorable status, whether we're talking revenue or cost variances. And that's a real problem. Again, going back to the prior chapter, molding behavior, and I've seen it in factories where I've worked. If they expect a certain amount of output, and that's what we're going to do. Why? Well, if we don't meet it, probably get in trouble, unless we have reason why, legitimate reason. On the other hand, if we start putting everything out great guns, then they're going to up our standards and they're going to expect this all the time. Management, the common thought of management is that they typically do their best management when? In times of good or in times of bad? Huh? Bad. You're right. Management generally, the old saying is that their best management they do is when things are rough. You say, why? Well, things are good. It's like, hunky-dory, everybody's happy, laid back, whatever, right? In one sense, management cannot stand success. And that's why you got to be careful with this. Using analysis like this is let's don't keep ratcheting it up, because sooner or later, even a dumb monkey figures out, if I put my hand here, I get whacked. If I put my hand over here, I get a banana. Right? All those experiments they do on psychology, well, it's in the workforce too. And so if we find out, if we do everything really good and fast and all that, we'll get penalized because they'll just up the standards and it'll reduce our bonus or, cost us to work longer, make us look bad more often. And so what do? They drag their feet. Guarantee you do time and motion studies to set up some of these standards and all that, you probably don't want the workers to know what you're doing. Why? Well, if you're setting up standards of time and motion, I'm doing it, what am I going to do? I'm going to take as long as possible to do it. Why? To make sure I can beat whatever standard you set up. I mean, I don't know if you ever seen that happen or not in your life, but people, that's the way you got to do it. So, and again, I've told you this tale, but some of those online may not have heard. There was a company, like I said, I saw this years ago, and they set up a bonus system paying workers, and the first time they measured it, the workers were at 125% efficiency. And management, and they showed the board meeting, they had Denver's board meeting, they're going, well, that's good, that's great, you know, because they were getting bonus for anything over 100%. And then 6 months later, it was at 200%. And they said, okay, well, let's wait a few more months before we make decisions. It went to 250, 275, 325. Last time was at 400%. And,
That's a big old bonus.
oh, yeah. And they were talking about, they're going, man, this is wrong. I mean, board directors sitting there going, this is wrong. Our standards are way off. And one of the outside directors, meaning somebody not an officer in the company, at the board meeting said, are we making money? And the controller said, well, yeah, we're making more money now than we've ever made. Our profits are at an all-time high. He said, stockholders love us. He said, are our customers happy? They said, are you kidding? We don't even have to advertise anymore. Our customers keep coming back demanding more, and they're sending other people to us. And we can't even fill the demand we got now. We got waiting lists. He said, we've never had such quality of products. And that's why everybody loves us. He said, are the workers happy? He said, are you kidding? They're making more money off of bonus than they are their salary. Their wages are nothing compared to what they're making in bonus. So they're waiting at the door when we unlock it in the morning. We got to drive them off the machines to get them to go home. They won't even take lunch. They'll eat lunch standing working on the machine because they want to make more bonus, right? And that one guy says, workers are happy, making more money than they ever had. Companies making more money than they ever had. Stockholders are making more money than they've ever had, and they're happy. And our customers are happy. He said, now just tell me exactly what our problem is here. And they finally looked at each other and said, you know something? We don't have a problem. Our standards are exactly where they need to be. And, you know, they adjourned the meeting. And they went out and interviewed some of the workers and all that, and they were basically telling them, yeah, this is a great place to work. Love it here. And they said, what's one of the big differences now? Well, when we have a problem, when we see something going wrong, equipment, materials not are inferior, whatever, we tell them about it, they correct it immediately. And they go, and it gets done now. Instead of used to, one guy said, well, used to, we'd put in, tell them, well, this machine's not on right. He said they'd come look at it after a couple of weeks, and then they'd say, we'll get around fixing it whenever. And here we were putting a bad product out all that time. And he said, now when we say it, it's fixed that afternoon. And he said, difference in attitude. So again, it's one, and the story's illustrated. Be careful, just because you get favorable variances, make sure that you're not ratcheting things up just because, well, obviously everything can't be perfect all the time. And, you know, we can't get these good news all the time. And, you know, I've worked at firms and departments and things where that happens. And you learn real quick, well, I better not do that. Because if I do, they're going to expect that or more all the time. You ever work y'all find part-time jobs and things, right? Have y'all ran into that attitude with co-workers? Like, well, don't, what are you doing? You're too active. You know? Slow down. And part of it's just like what, you know, if you do this, everybody's got to do that. And it sort of, you know, defeats the purpose of what's going on. I did that. I found that out, worked stocking a drugstore, worked at, going through college, stocked a drugstore. Did a little bit of everything. Guarded tobacco warehouses in Lexington. They'd like the regional manager like freaked out when he found out I was carrying a gun. Now it's under 21. It's illegal in the state of Kentucky. Yeah. It was then. It may not be now. I was like 20 years old. I had to carry a firearm at this place. One of their guards' arm. Found out I was 20. Man, he not get to see me. Because if the state would have come in, he would have been fined. Big time. But different industries, different. So I mean, manufacturing, retail, you run into this all the time. Okay. That's all I've got today.